All right, if you're involved in the UK crypto market, you've probably noticed things are, well, they're getting a lot stricter. So the big question is, how do you stay on the right side of the law for the 2025/26 tax year? Don't worry, we're about to break it all down for you in this guide.
Let's just kick things off with a number, over 65,000. Yeah, you heard that right. That's how many of what they call nudge letters HMRC has recently sent out to crypto investors right here in the UK. If that doesn't tell you they're serious, I don't know what will. This isn't a niche topic anymore. It's front and center.
So, to guide us through this pretty complex world, we're leaning on the fantastic expertise of the professionals over at My Tax Accountant. These guys live and breathe this stuff, so you can be sure the information you're getting today is accurate, clear, and designed to help you handle your tax obligations without any of the stress.
So, here's our game plan for today. We'll start by looking at why HMRC is suddenly so interested in crypto. Then, we'll get into the huge difference between income and capital gains. After that, we'll crunch some numbers, untangle the mess of DeFi and NFTs, show you how to actually report everything, and then wrap up with some clear next steps. Okay, let's dive in.
First things first, let's set the scene. For the longest time, crypto tax felt a bit like the Wild West, didn't it? Well, I'm here to tell you, those days are long gone. HMRC is now looking at digital assets with the exact same level of scrutiny as they do for traditional investments like stocks and shares.
So you might be wondering, how do they know all this? Well, they're not guessing. HMRC now has data sharing agreements with all the major UK exchanges, which means, yes, they can see your transactions. They've also gone and added a brand new dedicated crypto section to the SA 108 capital gains form. And looking ahead, a huge international agreement called CARF is coming in 2026, which will make exchanges all over the world share user data. So those nudge letters, they're sent because HMRC already has the data. The bottom line is this: thinking you can fly under the radar is just not a viable strategy anymore.
Okay, on to Section 2. Now this is the single most important concept you have to get your head around. It underpins everything. It's the fundamental difference between capital gains tax and income tax.
The key trigger for capital gains tax is something called a disposal. Now, this isn't just about selling your crypto for pounds. A disposal is pretty much any time you get rid of a crypto asset, and you'd be amazed how many things that actually includes.
And this brings us to the two pillars of crypto tax. On one side, you've got capital gains tax. This gets triggered by a disposal. So yeah, selling for cash, but also swapping Bitcoin for Ethereum, or even using your crypto to buy a pizza. All disposals. Then on the other side, you've got income tax. This applies when you earn crypto. Think getting paid for a freelance gig in crypto, or getting rewards from mining or staking. Getting this right is absolutely fundamental.
And here's why it matters so much. The numbers. For the 2025/26 tax year, capital gains are taxed at 18% for basic rate taxpayers or 24% if you're a higher rate taxpayer. But if what you did is classed as income, you're suddenly looking at your normal income tax rates of 20, 40, or even 45%. That is a massive difference to your final tax bill.
And here's a little pro tip for you, because this one catches so many people out. You can absolutely 100% be on the hook for both types of tax in the very same year. The classic example is staking. The rewards you get are classed as income, and you need to record their value in pounds on the day you receive them. But wait, it doesn't stop there. That value now becomes the cost of that crypto. If you sell it later for more, that profit is a totally separate capital gain.
Right. Let's get into the nitty-gritty of actually calculating your gains and losses. I know it can sound a bit complicated, but it all follows a very specific set of rules. So stay with me. Understanding this next part is absolutely crucial, especially if you've been buying and selling the same coin multiple times.
You can't just cherry-pick your cheapest purchase to match against a sale to get a better tax result. Nope. HMRC forces you to follow a strict three-step process called share pooling, in this exact order. First, any sale has to be matched with a purchase made on the same day. If you have sales left over, you then have to match them against any purchases made in the next 30 days. Finally, any sales still left are matched against your Section 104 pool, which is just a fancy term for the average cost of all the rest of your holdings of that specific coin. It's rigid, it's non-negotiable, and you have to follow it.
Okay, after all that, here's a little bit of good news. For the 2025/26 tax year, every person in the UK gets a capital gains tax allowance of £3,000. Think of this as your tax-free buffer. You only start paying tax on any net gains you make above this £3,000 mark.
But of course, crypto is a roller coaster, right? It doesn't always go up. So what happens when you make a loss on a trade?
Is it just gone? Well, no. In fact, it can be pretty useful. You can, and should, use your losses to cancel out your gains in the same tax year. This lowers your overall profit and can even bring you back down into that tax-free £3,000 allowance. And if you have more losses than gains, you can carry the extra forward to use in future years. But, and this is the absolute golden rule, to be able to use these losses, you have to declare them to HMRC on your tax return. If you don't report them, they vanish. You can't use them. It's that simple.
Okay, let's wade into the really deep end now. We're talking about the cutting-edge stuff, decentralized finance, or DeFi, and non-fungible tokens, NFTs. The official guidance here is still playing catch-up, but there are some key principles we can work with. With DeFi, things like yield farming rewards are usually treated as income. But here's a tricky one. The act of adding or taking your money out of a liquidity pool can actually be seen as a disposal, triggering a capital gains event. For NFTs, it's a bit different. Just minting one isn't a taxable event. Selling it, however, absolutely is. That's a capital gain. But if you're a creator and someone pays you with an NFT, that's income. That's not all. Here's where most people go wrong with these assets. They fail to keep a record of the value in pounds at every single stage. Without that, you have no chance of reporting accurately.
We've covered the what and the why, so let's move on to the how. How do you actually get all this information and report it to HMRC? Let's walk through what the filing process actually looks like.
It basically boils down to two key forms. First is your main tax return, the SA100. Any crypto income you've made from staking, mining, airdrops goes in box 17 under Other UK Income. Then you have the SA108, which is the capital gains form. This is for all your disposals, and like we said, it now has a specific section just for crypto, where you need to put your total sale proceeds, your total gains, and, crucially, any losses you want to claim.
And whatever you do not forget these deadlines. For the 2025/26 tax year, which officially ends on the 5th of April 2026, you have two key dates. If you're old school and filing on paper, your deadline is the 31st of October 2026. For everyone else filing online, the big one is the 31st of January 2027. That's your last day to both submit the return and pay whatever tax you owe. Miss them, and you're looking at instant penalties.
Wow, okay, we have covered a lot of ground today, so let's bring it all together with a simple action plan and talk about where you can get help if you need it. Here it is, your crypto tax checklist. Number 1, keep perfect records of everything. Dates, values in pounds, fees, all of it. 2, be absolutely clear on what a disposal is for your activity. 3, use those share pooling rules correctly and in the right order. 4, take advantage of your £3,000 allowance and always report your losses. And finally, number 5, get your self-assessment filed accurately and before that deadline. Now, it's really important to say that all the information we've shared today is for general guidance. The tax world is complicated, and everyone's personal situation is different. You shouldn't rely on this alone to make financial decisions. Before you do anything, you really must speak with a qualified professional, like the experts at My Tax Accountant. And that's really the final point. If any of this feels like a bit too much, or you just want that peace of mind that everything is 100% correct, the best thing you can do is get professional help. The team at My Tax Accountant are specialists in crypto tax and can give you tailored advice for your portfolio, as well as help with any other tax questions you have. You can call them on 0208-570-8531 or drop them an email. Thanks so much for joining us.